Welcome to LifeGuide tutorial 2015-04 13th day. This is the fourth tutorial produced on this date. Just a note of caution, any figures shown are current as of today's date. However, these figures do change because the products and pricing do change and fairly rapidly over time. In this tutorial, we're going to look at something that a lot of people don't know, and that is the actual effective cost rate to finance life insurance on a monthly payment schedule versus paying for it annually. So what we're going to do is we're going to take a look here at a male born April 15, 1973, age last 41, age nearest 42. There was no backdating employed here because it would have necessitated quite a distance, several months of backdating, and perhaps it wouldn't make sense. So I just left it, so if we don't get confused with the backdating, I just left it at age last 41 and age nearest 42. So it's a male non-smoker, regular, and we're looking at a T100 for this lawyer with a face amount of $1 million. So let's just quote it. Quote, single life, single insured. And we have, for example, here Industrial Alliance, $8,730 per year for their T100 standard, payable for life. Now let's take a look at what the monthly premiums would be. Monthly premiums would be $785.70. So what is really the cost to finance these premiums? What's the cost of financing the $8,730 annual premium in monthly installments of $785.70 as it's calculated here? So what we do is we go to, we can minimize or we can close the quotation. I'll minimize for the sake of expediency here. And we'll go to a set of functions in LifeGuide, which is called the MultiCalc functions. And no, I don't want to load the data that was previously saved. There are various calculations that are available under the MultiCalc. And one of these is the Modal premium cost rate. So we'll put in the Modal payment, the monthly payment of $785.70, and we'll leave that on monthly, and we'll put in the annual premium, which would have been $8,730. And now premiums for insurance are normally paid in advance, so we'll leave that in advance. And as soon as we entered these figures, our results are shown at the bottom. The effective cost rate is 18.596%. The dollar cost in this case is $698.40. Now many people make the mistake of saying, okay, so if the dollar cost is $698.40, and if the premium is $8,730, that's not 18%. But the error in that assumption is that one would have to assume that in order for it to be a lower percentage rate, there would be no premiums paid through the year, but the total of the annual premium of $8,730 plus interest of $698.40 would be paid at the end of the year, but that's not the case. Insurance premiums are payable in advance. Moreover, it's not the entire premium of $8,730 that's being borrowed. but the amount of $8,730 minus the first month premium, which is $785.70. So actually less than $8,000 is being borrowed in this case. Let's take a look at the schedule. And here are the details. Okay, and here is the summary. If the annual payment amount is $8,730 and the alternative monthly payment amounts are $785.70 payable in advance, the effective cost rate is 18.596%, and the annual cost, in other words, total interest cost, is $698.40. And here is the schedule going through payment by payment from the beginning and going forward along with accrued interest costs as we go down. A lot of people don't understand this. Unfortunately, it's not taught in the LLQP as far as I know. But this should be known, as there is really no good reason for the consumer to pay that kind of a rate to finance thousands of dollars worth of insurance. At least that's my opinion. And thank you very much for watching. The next one is coming up shortly. Thank you.